Welcome back for another deep dive. Today we're going to be tackling a topic that you specifically requested.
Oh, wow.
Yeah. Financial charts.
Cool.
Yeah. And it seems like you're really interested in getting a better grasp on candlestick charts
Okay.
and what kind of insights they can offer.
Right.
Um, I have to admit, I'm pretty fascinated by them myself.
Yeah.
It's incredible how these visual tools can give us a glimpse into market psychology and help us anticipate potential price moves
Absolutely.
to help illuminate the nuances.
What I find particularly fascinating about candlestick charts is their ability to combine raw price data with a visual language that can reveal the underlying sentiment of the market.
Oh, so we're not just looking at cold, hard numbers.
No.
We're actually trying to understand the emotions and motivations of the traders behind those numbers.
Exactly.
Oh, okay. That's a great way to frame it.
It's about recognizing the push and pull between buyers and sellers, the fear and greed that can drive market movements. And the more we understand this visual language, the better equipped we'll be to anticipate those movements.
Okay, so let's start with the basics. My understanding from the materials you sent is that financial charts at their core are visual representations of a stock's price history over time.
Yes, think of them as a visual timeline, mapping out the price journey of a particular asset. And just like we have different types of maps for different purposes, there are various types of charts used in finance.
Like what kind of charts?
Well, the simplest are line charts.
Okay.
They connect the closing prices, giving us a basic overview of the trend. Then we have bar charts, which provide more detail by showing the high, low, open, and closing prices for each period. But for our deep dive, we'll focus on the most visually compelling type candlestick charts.
Candlestick charts, they're called that because they actually resemble little candlesticks, right?
Precisely.
At least that's what I've gathered so far.
They present the same information as bar charts, but in a much more visually intuitive way. And that's particularly helpful when trying to decipher the ongoing battle between buyers and sellers.
I'm already intrigued. So walk me through what makes up one of these candlesticks.
Each candlestick represents a specific time frame, which could be a day, an hour, or even a minute.
Okay.
And each candlestick has two main components, the body and the shadows.
Right. So the body, what story does that tell us?
The body, which is the thicker part of the candlestick, illustrates the price range between the opening and closing prices of that specific period.
So if the price goes up during that period, the body would be higher.
Yep.
And if it goes down, the body would be lower.
You got it. Now here's where it gets interesting.
Okay.
If the closing price is higher than the opening price, we have a hollow or white candlestick, indicating buying pressure or bullish sentiment.
So a white candlestick means the bulls are in control.
All right.
What about when the closing price is lower than the opening price?
Then we see a filled or black candlestick,
Okay.
which signals selling pressure or bearish sentiment. This means the bears have the upper hand during that period.
That's pretty intuitive. Just by looking at the color of the body, we can instantly see whether buyers or sellers were dominant during that time frame. But what about those lines extending above and below the body?
Right.
Those are the shadows, right?
Exactly, sometimes called wicks.
Okay.
They represent the high and low prices reached during that period, even if those extremes didn't occur at the open or close.
Okay.
Think of it as capturing the full range of the price action, showing us the extremes the market reached during that time.
So if a candlestick has a long upper shadow but a small body, would that suggest buyers tried to push the price higher, but sellers overpowered them and drove the price back down?
That's a very astute observation.
Really?
And it highlights a key point. The relationship between the open, close, high, and low tells a story about the dynamics between buyers and sellers.
It's like each candlestick is a miniature battleground, revealing who won the fight during that specific period.
Yeah.
This is really starting to click for me. I've also read about these candlesticks forming patterns.
That's where things get even more fascinating. By learning to recognize recurring patterns in these candlestick formations, we can gain valuable insights into market sentiment and anticipate potential trend reversals or continuations.
So these patterns are like clues that can help us decipher what might happen next. Can you give me an example of one of these patterns?
Absolutely. Let's start with a simple yet powerful one called the hammer.
Okay.
Picture a candlestick with a small body at the top and a long lower shadow resembling a hammer.
Why is that significant? Does it have to do with where it appears on the chart?
Yes, context is crucial. A hammer typically appears during a downtrend and suggests a potential reversal to the upside. What's fascinating is that this pattern reflects the psychology of the traders involved.
What do you mean?
Imagine a stock is in a downtrend.
Okay.
Sellers are in control, pushing the price lower, but then suddenly buyers step in aggressively, driving the price back up. This creates that long, lower shadow,
Yeah.
showing us that the price tried to go lower but was met with strong buying pressure.
So it's like the hammer is hammering out a bottom, signaling a potential shift in momentum.
That's a great way to visualize it.
Okay.
Now, it's important to remember that no single candlestick pattern guarantees a price reversal.
So we shouldn't rush out and buy a stock just because we see a hammer. What else should we consider?
We need to look for confirmation from other indicators, assess the overall market conditions, and manage our risk accordingly. However, seeing a hammer after a prolonged downtrend can be a powerful indication that the selling pressure might be weakening.
That makes a lot of sense. It's like a detective looking for clues. A hammer might be a significant clue, but we need more evidence to build a solid case. Now, what are the opposite of a hammer? Is there a bearish equivalent?
You're thinking along the right lines. The bearish counterpart to the hammer is called the hanging man. It also has a small body and a long lower shadow, but it appears during an uptrend?
So instead of hammering out a bottom, it's more like a warning sign that the uptrend might be hanging by a thread.
Precisely. The psychology behind the hanging man suggests that buyers tried to push the price higher, but sellers came in strong and drove it back down. It's a sign that the bullish momentum might be waning.
So it's like a tug of war between buyers and sellers. And the hanging man suggests the sellers might be gaining the upper hand. Are there other single candle patterns that stand out as particularly useful?
Definitely. The shooting star is another one to watch for. It's essentially an upside-down hammer with a small body at the bottom and a long upper shadow.
So if the hammer signals a potential reversal from a downtrend, the shooting star would signal a potential reversal from an uptrend.
Exactly. It suggests that buyers tried to push the price higher, but sellers overwhelmed them, driving the price back down. The long upper shadow reflects that failed attempt to move higher.
This is making me think about how important it is to consider where these patterns appear on the chart. A hammer at the bottom of a downtrend is a very different story than a hammer in the middle of an uptrend.
You're absolutely right. Context is everything in candlestick analysis. We need to look at the bigger picture, the overall trend, and other supporting indicators to determine the true significance of a pattern.
That makes sense. It's like piecing together a puzzle. Each candlestick pattern is a clue, but we need to see how they all fit together to get the complete picture. Now, I'm curious about those patterns that involve more than one candlestick. Can you give me an example of a two-candle pattern that traders find particularly insightful?
Certainly. One of the most powerful two-candle patterns is the engulfing pattern, which comes in both bullish and bearish variations. Let's start with the bullish engulfing. Imagine this. You have a downtrend in progress, and then suddenly a large white candlestick appears, completely engulfing the previous black candlestick.
So it's like the bulls came charging in and completely took over, overwhelming the previous selling pressure.
That's a great way to visualize it. The bullish engulfing pattern is a dramatic shift in sentiment, suggesting a potential reversal to the upside.
And I assume the bearish engulfing pattern would be the opposite, signaling a potential reversal from an uptrend to a downtrend.
You got it. In this case, a large black candlestick would engulf a smaller preceding white candlestick, indicating that the sellers have taken control. Now, there's another two-candle pattern I'd like to highlight called the piercing pattern.
What's interesting about the piercing pattern?
It's a bit more subtle than the engulfing pattern, but can be equally significant. The piercing pattern occurs during a downtrend. It starts with a long black candlestick, followed by a white candlestick that gaps down at the open, but closes at least halfway into the body of the previous black candlestick.
So it's not as dramatic a reversal as the engulfing pattern, but it still suggests that buyers are starting to step in and challenge the downtrend.
Exactly. The piercing pattern is a sign of potential bullish momentum building, but we'd want to look for further confirmation before assuming a full-blown reversal is underway.
Okay, that makes sense. We need to see follow-through from the buyers to confirm that the trend is truly shifting. What about other two-candle patterns? Are there any with particularly interesting names or stories behind them?
You might find the harami patterns intriguing. Harami means pregnant in Japanese, and you'll see why when you visualize these patterns.
I'm all ears. Tell me more about these pregnant candlestick patterns.
A bearish harami occurs during an uptrend. We see a large white candlestick followed by a small black candlestick that's entirely contained within the body of the previous white candle. It's as if the large white candle is pregnant with a smaller black candle.
I see it. That's a very visual way to remember the pattern. So what does this bearish harami tell us about the market sentiment?
It suggests a potential shift from bullish to bearish sentiment, The fact that the second candle is small and contained within the body of the first candle suggests that the upward momentum is waning and a reversal could be on the horizon.
So it's a warning sign for the bulls? What about the bullish counterpart?
The bullish Harami is the same pattern but in reverse. It appears during a downtrend, starting with a large black candlestick followed by a small white candlestick, entirely contained within the body of the previous black candle.
So it's like a small glimmer of hope emerging within a downtrend, signaling that the sellers might be losing their grip.
Precisely. The bullish Harami suggests that selling pressure might be weakening and a potential reversal to the upside is possible.
These patterns are amazing. It's like learning a whole new language to understand the market's whispers. Now, I'm curious about those patterns that span 3 candlesticks. The names Evening Star and Morning Star sound particularly intriguing. Can you shed some light on those?
Those are classic 3-candle patterns that signal potential trend reversals. The Evening Star, as the name suggests, appears at the top of an uptrend.
Okay, so we're looking for this pattern when the market has been moving up for a while.
Exactly. The pattern starts with a large white candlestick, followed by a small-bodied candlestick that gaps up, creating a scar formation. Then a third candlestick, typically black, closes well into the body of that first white candlestick.
It's like a bright star suddenly appearing only to be followed by darkness, hinting at a potential downfall.
That's a great visual. It suggests that the buying momentum that drove the initial uptrend is fading, and a potential reversal to the downside is looming.
So it's a warning sign for the bulls. Now, what about its bullish counterpart, the Morning Star? I'm guessing this one appears at the bottom of a downtrend.
Precisely. It follows a similar structure to the Evening Star, but in reverse. We start with a large black candlestick, followed by a small-bodied candlestick that gaps down, forming the star. Finally, a third candlestick, usually white, closes well into the body of the first black candlestick.
So it's like a glimmer of hope emerging after a period of darkness, signaling a potential shift from bearish to bullish sentiment.
Exactly.
Yeah.
Now let's talk about a pattern that often throws traders for a loop. The doji.
The doji, what makes it so tricky?
The doji is unique because it has a very small body or sometimes no body at all. This means the open and close prices are virtually the same. It often looks like a plus sign or a cross.
Huh. What does that tell us about market sentiment?
The doji signals indecision. It's like the bulls and the bears are locked in a stalemate, neither side able to gain a clear advantage. This indecision suggests that the current trend, whether up or down, might be losing steam.
So is it a bullish or a bearish signal?
That's the tricky part. The doji's meaning depends heavily on the context and what happens next. For example, a long-legged doji with long upper and lower shadows shows a high degree of volatility and indecision.
It's like the market is trying to make up its mind which way to go, but just can't decide.
Precisely. Now, if a doji forms after a prolonged uptrend, it could be a warning sign. Take the gravestone doji, for example. It has a long upper shadow and no lower shadow resembling a gravestone, and it can foreshadow a potential bearish reversal.
Okay, so we need to pay close attention to where the doji appears on the chart and what other patterns or indicators are suggesting.
You got it. Candlestick patterns, while fascinating and insightful, should never be used in isolation.
Yeah, I think I'm starting to see that. It's like we're building a detective's toolkit. And candlestick patterns are one of the tools we can use to analyze the market, but we need other tools as well.
That's a great analogy. We should also consider other technical indicators like trend lines, moving averages, and volume. And of course, fundamental analysis of the underlying company or asset is crucial.
Well, this has been an incredible deep dive. I feel like I've gained a whole new perspective on how to read the market.
I'm glad to hear that. Remember, the key is to observe, analyze, and practice. The more you study candlestick charts, the more intuitive it will become. You'll start to recognize patterns naturally and develop a deeper understanding of market psychology.
You know, it's like learning a secret language that reveals the inner workings of the financial markets. Now I'm wondering what other tools or techniques could we explore to further decode these market mysteries. That's something to think about as we wrap up our deep dive today. Thanks for joining us.